Hey Shane, welcome to the last market commentary for 2023.
Can't believe it's over, man. We've been at this a while now. It's like almost 2 years worth of doing Elevate chats. Even though we only do them once a month now instead of once a week. Um, feel like feel like I'm a veteran.
Same here. So, looking forward to doing this one just because, it's the end of the year. I think I told you my personal account, I'm all cash. This is just a time of year where you just want to kind of detach from the markets, enjoy time with the family, and, starting in January, think about what's coming. But we'll get in that today and, talk about some fundamentals, our market commentary, and then a couple technical slides. So,
Yeah, you doing anything for Christmas?
I am sticking around and just spend time with family.
Cool. Yeah, I'm heading to Detroit for a Trans-Siberian Orchestra concert with my grandma, so that ought to be fun.
That ought to be fun. I've never been to one of those, but it sure looks cool.
I've never been interested in it, but she is, and so that's it. We're going. Should
Awesome.
be fun.
Well, we can go ahead and just kick things off here, but for anyone tuning in, it is December 21st when we're recording this, kind of midday, but muted session, so nothing overly exciting in the markets while we're recording.
At least until 2:30, probably right when we wrap up, just like yesterday when the market decided to sell off at 2:30. Of course, they wanted to blame a big 0 day till expiration options trade, but maybe it was just some funds taking profits off the table before the end of the year, which happens. And when that happens in a low volume environment, like Kyle said, he's not in the market. There's lots of people who feel the same way. They're not in the market. Um, so things can move in a big way on low volume because there's just nobody around to take the other side of things. So yesterday was interesting. Market was up 0.5%. I was on the golf course, um, having a good time and counting all my gains. And then I got to the next tee box and looked at got out the phone and looked at the trading account. And was like, well, we went from being up 0.5% to the market was down, 1% or more. I think at a little, so I think from top to bottom, Nasdaq was down almost 2% yesterday, and it all happened in like 60 minutes.
Yep.
Um, and right at 2:30 does kind of there's a lot of firms out there that'll start their trading, their algorithmic trading, on an automated basis to send a certain number of shares every 10 minutes or every 2 minutes or every however many seconds until the end of the day, because that's when all the volume comes into the market. So it's a little ironic when things start exactly at a 30-minute increment. It's usually a man-made event. Not that everything in the market isn't, individuals ultimately making decisions, even if it's robots making decisions that were trained by humans. I don't know. To me, that just smells like they're probably not
Yep.
done, right? Whoever had all that to sell probably didn't just sell it all on one day and now they're done for the rest of the year. They're probably going to do it over the next several days, is
Yep.
my guess. But
And
we'll
it's
see.
interesting that's the topic because the first thing I wanted to bring up is the biggest whale out there. That's Berkshire Hathaway and their cash balance. So, as you said, it's in investing to be successful, being a bit of a contrarian is very helpful. So when things get stretched to the upside, take a little profit. That's certainly what you probably saw yesterday. We've had, I don't know how many green days in a row now. And then on a low volume environment, not a surprise. But Shane, you put this chart in here, and this is, Warren Buffett's cash balance. What is this kind of telling us?
Well, I think it speaks for itself. It says that the best investor of all time is preparing for prices to get cheaper. He wants to have a whole bunch of cash available to invest when there's blood in the streets, as he likes to say. And so the only way to do that is to raise cash ahead of time. And he's been known for doing that. He's not a market timer necessarily, but you want to be contrarian at extremes. Most of the time you don't want to be contrarian. Like most of the time you want to follow the trend. But when things get extreme, you definitely want to take the other side. And so you can see Warren was raising a lot of cash and put some of it to work during the COVID sell-off. But since then, he's been raising cash again, and I think it finished with, this most recent quarter he sold GM and Johnson and Johnson, a great company, and Procter and Gamble, a great company. But he sold all of it. He doesn't own any, and now he's going to take and put that cash to work, um, hopefully at fire sale prices, which I think he probably thinks are coming in the next year. But it's not like it's not a quarterly or monthly timing tool. It's, Warren can be patient. He's very patient investor. He could wait for years before putting this money to work. Granted, he's 93. He might not be around to see it all get to put to work if he waits too long, um, but I think he's probably taught the people who work for him who are taking over, how to be patient. And so we'll see how long it takes to put that money to work, but it's, money talks, right? People say all types of things. You wanna see what they're doing, and this is what Warren's doing. He's raising a lot of cash, and he's probably not doing it just for the fun of it.
No. And something to be aware of too, you know, a retail investor, they can get in and out of the market, no problem. They don't impact it. If he wants to go buy a select name, he can't just hit the button and get out, because if he does that, it'll go down 10, 20%. So there's a liquidity issue there. And what that tells you is that, when he's raising cash, he's probably getting it in or out well ahead of a move that he sees coming. So it's not going to resolve in a few days. It's not going to resolve by just being a 1 to 5% move. Usually it's a larger percentage move that somebody with that much capital is looking for. So, it doesn't mean the world's ending or anything, but it does mean he is peeling back risk.
And what's the right way to say this? Can you imagine somebody on his team calling him up and saying, "Hey, Warren, you're an idiot. You missed out on the 10% November 2023 rally. The market was up and you had raised all this cash right before the market decided to rally 10%. You're such a dummy." Um, like, you think it would even bother him, or do you think he would probably just laugh and be like, "You have no idea what you're talking about. Like 10%. I'm not here for 10%. I'm here for thousands of percent over decades, compounding my capital with little risk." He doesn't care about a
Yep.
10% move in a month. He's like, that's a blip on the radar during if you could, open the stock market for as long as I've been alive, like, stop it, leave me alone.
Yep.
So anyway, yeah, patience is the key.
It is. And, something he might look at, or, certainly has caught our attention, is this ratio chart of the NASDAQ 100 to the Russell 2000. So looking at this, Shane, if you want to just talk through this valuation, kind of what it tells us.
Yeah, I'm not going to spend a lot of time on it. I think I do a pretty decent job of explaining it in the commentary. So if y'all want to go read that, feel free. But it's just pictures worth 1,000 words, right? So I won't waste your time saying all 1,000 words. The big takeaway here is that the Nasdaq relative to 100 companies of the Nasdaq relative to 2,000 companies, which represent the broader market, certainly small companies, is more expensive than it's ever been. And the last time we got this expensive, the Nasdaq crashed by 80% over the next few years. So, not saying that the Nasdaq's going to crash by 80% over the next 3 years, but also not ruling it out. I mean, you never know. Back in 2007, 2008, last time it peaked like this, this was in 2000, but back in 08, 09, during the great financial crisis, everybody was pretty complacent in 07 heading into it. And, nobody was Yellen and Bernanke and everybody was talking about how there wasn't going to be any issue. And I feel a lot of that complacency out there in the market right now, that, yeah, banks are failing, but it's contained. Everything's going to be fine. And it just feels really similar. So, history often repeats,
Yep.
or at least rhymes. So
I would agree. And, big thing, it doesn't mean it has to go lower. It could mean, back then, Apple, that was a company there, Yahoo, other tech companies, and they were great investments 20 years down the road, but they did get ahead of themselves, and we might be there. And it might just mean maybe some other sectors look a little better. But
Well, I don't have the chart in here, but if you had bought Microsoft in 2000, you would have been down like 30% over the next 13 years, despite the fact that Microsoft grew its earnings by 8% a year every year. So it was a great company, a great buy, but it was not a good price. Cisco is the poster child. It was trading at a $500 billion market cap back in 2000, and it's never approached that since. So Cisco, great long-term business, but never has gotten back to that 2000 peak.
right. So, NVIDIA is the first one that comes to mind when I think of that. Maybe AI is the biggest thing the world has ever seen. But that doesn't mean the valuation's correct today, and it might correct a little. So,
Or a lot.
not calling directions, but that's kind of what we're looking at when you're pulling information from that. So now the other one is, so M2 money supply. That's really a measure of liquidity in the markets. That's dollars chasing assets. Shane, any takeaways on this one?
Nope, just that we're in an unprecedented territory. So for people who have been to business school and they look at the the traditional I guess like GDP times M2, equals this and that. I can't remember do you remember offhand what that measure is? My gosh, I can't, the term is escaping me right now. Oh, what is it? Whatever. It's not that important, but you don't, I'll find it next time you start talking because I will go dig it up somewhere. Oh, I think I found it. Hold on. Let's see. The quantity theory of money. There you go. That's what it is. The quantity theory of money. So the more money in circulation, right, and the higher the GDP, then the better the economy is going to do, and stocks are going to go up, kind of thing. It hasn't really been proven out. Like empirical evidence doesn't demonstrate that it's a real thing, and I still don't have the actual formula for it, but it's a simple one, and it involves if M2 is going down, it cancels out any uptick in the velocity of money, and so less money in circulation means lower prices at the simplest level, and so as you can see by the red line right here, on a percent change basis from a year prior, M2's never shrunk by this much. And if you look at the blue line, you can also see that like M2 has, mostly always goes up. And only over the past, year and a half has that blue line shown any material decline. So it's kind of uncharted territory, and anybody who thinks they know how this is going to, anybody who tries to brush this off as not a big deal, I think is not paying attention, because you really don't know. I mean, maybe they'll be right and it's not a big deal, but it's also possible that it's a very big deal, and we will definitely see an issue. So time will tell.
That it will. So Shane, you're really good putting all these other charts in here. One I was looking at that's obviously caught your attention is this cost of US debt. So yeah, it's easy for us right now. I just go, oh, I want to buy a house, but now interest rates are a lot higher. Well, what if you have the federal government? So what are you seeing here on this one?
I think that one's pretty self-explanatory and terrifying. I mean, our government is bankrupt by any financial sense, absolutely insolvent, right? Like the only way that we can afford to make any payments is by printing more money, which is of course what causes inflation to begin with. So we don't, they don't take in this kind of money in tax receipts every year. There's no way to make these payments. So we'll see where that takes us in the long run. But that forget what the number is, that it's actually over $1 trillion, but like look at the like how fast that thing is going up. It's not like it started to come down. It's not done. It's gonna keep going up. It's bananas. So that's terrifying. By the way, I got that the formula is money supply times velocity of money equals the price level times real GDP. That was the formula. So money supply times velocity of money, and M2 is what money supply is, equals the price level times real GDP. And so anyway, that's I knew I would find it eventually. But yeah, this is just, we'll get to it later, but the personal interest payments doesn't look much better. Pretty similar looking chart actually.
It does not. So, and
So the
then
government's bankrupt and lots of people are bankrupt.
yeah, and then this is one too. So just on that note, why things can kind of work is that foreign countries keep buying US Treasuries. So that helps fund deficits. And this chart here is showing us what those foreign countries own for treasuries. And Shane, it looks like it's going down. Is that the correct interpretation here?
Yeah, at least as a percentage of our outstanding debt, foreign countries own, about around a little over 20% of it now. It used to be almost 40% back in 2014. So as we print more money and inflation, inflate away the value of our dollars, foreign governments are less interested in owning our debt because they see the interest payment chart that we just looked at, and they're questioning, why would I want to loan the United States money for 20 years? I have no idea if they'll be able to pay me. So yeah, less interest by foreign governments in owning our debt, and I think countries like China are actively selling it, which probably keeps interest rates materially higher for longer.
Yep. And I think part of that too is it lessens the ability a little bit for the US to just print more dollars
Yeah.
and solve all their problems. So,
Or hopefully borrow more money, because I mean the only way to get people to buy the debt is by offering a higher and higher and higher interest rate, which is why you see the interest payment thing going over $1 trillion a year. I mean, they're obviously related.
yep. So, and then Shane, any other charts in that little block that you'd like to dig
Nope.
into a little more?
Nope. I think we can go to the
All right.
bottom.
This one, we don't have to view it, but I encourage anyone to click on this Stanley Druckenmiller's little speech here, conversation with CNBC. He certainly is somebody that is well worth listening to.
Yep. Definitely want to pay attention.
All right. So I think that's just about it on that, huh?
No, hit
Think,
that first chart above. We don't need to spend too much time on it, but it's pretty self-explanatory. But Google Trends is awesome. So give car back is at an all-time high. The month prior, I said it was can't pay credit card was a search that was at an all-time high. So people can't pay back their credit cards and they can't afford their vehicles, and so they're asking Google what to do about it. Probably not a good sign of a strong, healthy economy.
it is not. So, all right. Anyone else wants to go in here? They can go look at some of these,
Well,
but
hold on. I do want to just hit these real quick. Hit that one with the blue line there. Nope.
oh,
There you go. So more evidence that the consumer is doing very well. The ability to pay for an unexpected $2,000 expense is at an all-time low.
yep. And it's
So
always
that's
interesting, and we'll talk about this more, but looking at the economics or the fundamentals of the economy, it's definitely not looking like a good picture. It doesn't mean for sure what the stock price should be or where the market is, but it's hard to ignore this, and they oftentimes will catch up to each other.
Yep. And then next one is from Sentiment Trader. Don't skip it. There you go. So you can see pretty clearly here that when dumb money, which is the red line on the bottom series, gets very high, and it just recently went higher than what it shows here on the list, usually a decline follows. And I don't have time to unpack what dumb money versus smart money is, but we have various ways of calculating, which people are doing what through various things like put to call ratios and commitment of traders reports from the COT. And so we can see who's putting their money where, and we can tell that when dumb money gets that much more confident than the smart money guys, usually the market is setting up for a drawdown. So we'll see what happens this time. So far, hasn't moved down too much except for yesterday. So we'll see if yesterday was the start of something a little bit more material, but I wouldn't be surprised to see the market head lower, despite everybody, wanting Fed rate cuts and a Santa Claus rally. I don't know. Nothing will surprise me anymore, to be honest, but don't be surprised if the market just trends lower from here.
Yep. So with that, we'll go ahead and flip on over to our
You really
slides.
wanna go,
Or
hold on, look at that
what
last
are we
one.
missing?
See where it says 33 trillion on the debt? Well, I just looked at it, and if you actually, Kyle, can you go to your browser there, and in the address bar, type in usdebtclock.org. We're not quite 34 trillion yet, but in the top left corner, you see the US national debt ticking higher, 33.934 trillion dollars that will
That
never be paid back ever. Ever.
that is terrifying.
Yeah. So look at that, per citizen. Everybody watching this, you owe 100,000, 100, almost $101,000. How many of you watching this can afford to just hand over 100 grand to knock out this debt tomorrow? Yeah, that's what I thought. Some of you certainly, I know. Um, but you don't want to, and you probably didn't get much benefit from all that borrowing. And look at that, per taxpayer, which I'm sure all the people who are watching this are paying taxes. But many people in this country do not pay any income taxes. And so per taxpayer, that 33.9 trillion works out to $260,000 per taxpayer. Yeah.
Yep. Big numbers.
Sobering, man. Sobering. It's never getting paid back. There's zero chance it will ever get paid back, especially in today's dollars. The only way to pay that back is to print $34 trillion, which of course will explode inflation in ways you never thought possible.
Yep.
But it's all fine. Buy stocks. It's all fine. No big deal.
All right. Are we ready now, Shane?
Yeah, go for it.
All right.
Kyle's
So-
really excited to get to the presentation today, as we can tell.
I am. I started off with, so I've got 2 slides here. Again, so Shane, I brought up there's 2 sides. There's the economic, or fundamental side of looking at things, and there's the technical. And one thing is that, the NASDAQ 100 has hit a new record and the S&P 500 is very close. Typically, that is not the behavior of a bear market. But, you got to be aware of, yes, that is an input. That does not mean that, yes, this is a bull market, go buy a bunch of stocks, because I will tell you in my own, investing and trading, we had this nice run up, but I'm looking across the board and all I see is a lot of overstretched names. And that's not a great time to put new money to work. If you have money in the market, maybe you can just make sure you're managing that risk well. But thinking, oh, I missed it and jumping in now would not, that's that dumb money category we were talking about, is chasing trends you missed. But we'll see how it pans out. But right now, people are willing to buy stocks up here, and there's this other side and they are selling their stocks up here. So you just have to consider why are they doing that? What's their reason? Buyer thinks it's going higher, seller thinks it's going lower, but nothing's ever, certain. Just something to look at though when it comes to price action.
Yep. We're definitely some resistance to get through there, but if it does, I mean, it's going to be hard to argue. It can be a bull market. Like remember 2021, there was no fundamental economic reason that the market should be so bullish, but it went up a lot anyway. So,
Yep.
They don't line up.
And then, the other part of that is we've talked about the Magnificent Seven. Everyone's heard about those. Well, they made up so much of the market gains this year. And that's not necessarily a bad thing, but what you want to see after that is expanding market breadth. So you want to see other sectors participate, other stocks participate. And looking at this is just the large cap percentage of large caps in the S&P 500 that are above their 200-day moving average, all the way to the 20 and 5-day moving average. And what I would like to see more of is that sector rotation. So we saw tech really lead. I want to start to see maybe industrials start to pick up, different sectors. And I don't want to go bottom fishing here for the ones that are below their 200 still and just don't look good. Consumer staples right now is kind of standing out as not a strong area. So just a good way to, if you tune out all the noise, this is what actual stock prices are doing. Does this mean it's all clear for next year? I would caution you towards no. You can ride this trend, but you got to manage that risk because while these are moving that way, you cannot ignore fundamentals that might catch up with people that just got a little too excited and ahead of themselves here.
That was the most bearish thing Kyle's ever said. Just kidding, man. Just
For
kidding.
this year anyway. So I like to look at the price action, but that's where we are. So I think it does right now look bullish if we just look at price action, but you cannot ignore the underlying risks there and you need to manage risk accordingly.
Yep,
So,
for sure.
but here's the big one. This is still a conversation that is just about everywhere, and it is a very big problem, and that's inflation. So, Shane, I don't know if there's some stats that you wanted to highlight, but I can tell you this one. It's been a frustration for me because since graduating college, I've seen it in my age class is that everyone was looking for when are wages going to pick up. And now you do have like real inflation. And I'm sitting here and it says 24% of people think their income is keeping up with inflation. That's a pretty dismal number.
Yeah, I don't even know if it's if they think it's they know. They know it's not. I mean, they've been to the store. They see how much money people, with money are spending on things that are, are non-essential. I mean, just look at the crazy things people. I mean, Elon Musk spent $45 billion on Twitter. I mean, think about that, Like people are having a hard time. Like real people in the real economy don't have money. I mean, they can't, fewer people than ever can deal with the $2,000 emergency expense. Like they go to the grocery store, they go to the gas station, they go get a car wash, they, for whatever reason, use things like Uber Eats, which I can't understand. Thankfully, my daughter was gonna use Uber Eats last night, and after she saw how much it was gonna cost her to get Chick-fil-A delivered to the house, she was like, "I'm not doing that." And I said, "That a girl? Like, you don't do that. It's ridiculous. I mean, it was gonna cost like $30 for a $5 chicken sandwich, and of course, it was gonna get here cold." So some of those things just kind of amaze me, but people know what's going on. And so they know that their income is not keeping pace. They know that their purchasing power has been eroded. They know that prices haven't gone down. They just aren't going up as fast right now, but they haven't gone down from 2 years ago. Um, it's amazing to me that they blame the government spending. 56% of them blame government spending for what's causing inflation. 50% are very confused about companies overcharging. So they want, some socialist prices. Companies wouldn't overcharge if the government didn't spend so much, print so much money. Um, at least most of them. There's always bad actors out there. Global and international factors are kind of an interesting scapegoat. Um, and then of course blame China for anything, supply and manufacturing wise. It's easy to blame China for stuff, or blame Canada if you're South Park. The condition of the U.S. economy being good is only 34%, bad 62%. I don't know where the 34% of the people are getting their information, to be honest. I think it should be about 0 to 100. Um, and the most important problem facing the U.S. is still inflation. So I would argue that immigration at the border is probably the number one problem, but we won't know that until something really, really bad happens in this country, and we find out that the people who did whatever it is that's really, really bad that might happen, came across the border without anybody trying to stop them. I don't know if you saw it recently, but the FBI guy, the director of the FBI, not that I have a ton of faith in our law enforcement, our national law enforcement organizations, particularly the FBI, but he testified, I think, in a Senate hearing recently and said that, there's talked about these blinking red lights that were very present in the world or in our country before the 9/11 attacks. And, he kind of correlated that to like right now, like, man, there's a lot of crazy things happening and we don't know who's coming across our southern border, which is kind of terrifying, to be honest.
Mhm.
Something I don't, it's not an investable thing. It's just something that I think is probably a very important problem. So no surprise that it's number 2 on the list.
Yep.
But I would give it more than 20%.
Yeah, I would. Yeah, I think it's a risk. I think, hey, we're all from other places originally. So, all four people coming over. Just nice to know who's coming over first. So,
Yeah, for sure. For sure. It'd be nice to know that they're not like a member of a terrorist organization, for example.
exactly.
Yeah, pretty
So,
basic stuff.
but Shane, this is the Fed statement from the last meeting, and I thought there were certainly a few key turning points in here that you highlighted. Um, one is this Fed pivot, which I think you and I are both tired of it, thinking that Fed pivot's something that's positive. It's not. It just kind of means you blew something up and you accomplished the mission. But what were your takeaways on this one?
What's striking to me is how little changed and how the market uh interpreted it as being very dovish, but none of this to me seems dovish. It just seems maybe a little less incrementally hawkish. So the recent indicators suggest that growth of economic activity. So, okay, economic activity has grown, uh, is slowing from its strong pace in the third quarter. So the growth of economic activity is slowing or has slowed. Um, that's not bullish. And the only reason you would cut rates is if you were worried that economic activity was going to crash, basically. And we'll get to that in a minute. But inflation has eased over the past year, but remains elevated. Okay. We all knew, like, that's nothing new. We all knew that it had eased. So that's in there. And then the word any in the middle of the page there. It wasn't really that much different,
Yeah.
but the market interpreted it as, oh my gosh, they're gonna cut rates tomorrow. And I just don't think they're gonna. I mean, eventually they will, sure, but I don't think by as much or as soon as the market is currently betting.
Yep. I basically got that, growth has slowed a little. That was, mission accomplished there. That's what they've been trying to do. Inflation's lower, but still high. So nothing saying economy strong, interest rates low. Give me that. And yeah, that's one strong bull market, but this isn't anything to get excited about. And Shane, you found this fancy new tool with Bloomberg, just deciphering how many hawkish sentences, moderate, dovish, all that. Uh, what'd you walk away with here?
Yeah, pretty pretty interesting. That they analyze every sentence and every word, the number of dovish sentences versus the number of hawkish sentences. And so we can see that below zero here, we are in hawkish territory overall. But again, the market clearly hasn't interpreted it that way. So whatever the market's going to do what the market wants to do, and nothing you can do about it. But if you look at the data, if you just kind of tune out the noise of the market and look at the data, it was more of a hawkish. This is the statement that we just looked at on the prior page with those minor changes, and again, like from last time, it got incrementally a little less hawkish, right? But it's not dovish.
Right.
Kind of hard to see my drawing there in this red, but anyway, that's it. So pretty cool that these tools exist, and we've been test driving the Bloomberg terminal for a month, and it's been pretty cool to get access to some of this stuff.
Yep. And then here's another one on Fed sentiment index. Looks again like was it just a little more positive sentiment? Is that what a reading of
Nope,
4 would equal on that, or
nope,
other way around?
more
Oh,
hawkish. So got more hawkish. So up here is hawk, and down here is dove. So the more it goes this way, the more hawkish they are. The more it goes this way, the more dovish they are. And so, as you can see, we got less dovish and more hawkish on the sentiment indicator, which caused this white line to go up. So the data, again, from a second source, not the same as the prior source, it was more hawkish. Certainly hawkish, but even more hawkish on this basis. So the data, says that it's hawkish. The market interpreted it as dovish, and that's why you got, after the release, you got a whole bunch of different Fed presidents coming out and saying things like, I don't understand the market's reaction here. We are not thinking about cutting interest rates. Like they're very clear about it, and the
Yeah.
market just does not care right now. It will, eventually it will. Eventually it takes time, but they'll realize like, oh crap, we're on the wrong side of this. We're betting on 75 basis points of rate cuts in the first quarter, and it's going to be 25 basis points of rate cuts in the third quarter. And when the market realizes that, um, it stairs up, elevator down. It goes down a lot faster than it went up. So if you thought the up move, in November was fast, just wait and see what happens if it turns out that the market got it wrong. It'll reverse that even quicker.
Yep.
So we'll see.
So this is when I'm fascinated. I haven't seen the statistic, but buy now, pay later services.
Yeah.
Just, I mean, anything I buy online now, it asks me if I want to finance it. And we're talking
Yeah.
like $50 purchases, just unbelievable. But
Pay for your t-shirt over the next 4 months. Like what? A t-shirt? Like why? At Walmart actually just rolled out more buy now pay later options at the self checkout. So Walmart's doing so well that they need more help from buy now pay later because their clients are in such bad shape that they can't afford to pay up front for everything. So the only way that Walmart sees they can get their profits growing and their revenue growing is by offering more buy now pay later, which of course just shifts the due date on the purchase for the consumer to a later time, and they can't afford it. They already can't pay for their car, and they can't pay back their credit card, and um, so buy now, pay later is like is the answer, I guess. I mean, right up until it's not, because the well, this part, is not surprising. The
yeah,
young people use it more than the old people. No shock there. Uh, but the other two, 27% of people are using it as a bridge loan until their paycheck. So all that means is they're spending their paycheck before they get it. Okay, that's been around for as long as there's been paychecks. Um, that we used to call those cash advances or payday loans, right? Anybody ever seen payday loans being a good solution to to an income problem? No, I mean it's bonkers. Um, and then of course the number of people with a late payment is not good. That's a lot.
yep.
I mean, as long as they ultimately pay it, okay, fine. Paying late only means you pay more in interest usually. So not sure the implications on that, but it's not indicative of a strong and healthy consumer. Tell you that
It,
much for sure.
no, definitely not. So interesting stat there. And then here's again the Powell pivot. So I don't know your takeaway on this one.
I didn't even realize that this slide was in here, but I'll tell you what, if you just I won't get into this because I haven't really thought it through, and I might write about it in the upcoming commentary, but this is where'd you go? This is what I would read. It's this bold text right here. So there you go. Because the interest rate bill of the US is ballooning, that might be the reason for the Fed, you know, being a little bit less hawkish, for example. I'm here to tell you that if that's the reason that the Fed is not hiking rates anymore, it's not going to be a good situation in 2024. It means that they will end up printing money and buying bonds and trying to save the economy from crashing. So, so it's not a sign of something good
No,
that they're done. If that's the reason behind it, and this is all speculation, just so by whoever this person is on Bloomberg. Haven't really thought about it, but it's interesting to see because down here it says perhaps Powell is returning the favor to Janet Yellen. Janet Yellen said, "Hey, we're going to buy all these bonds," and now he's saying, "Cool, we're going to cut the interest rate that you have to pay on them." So you scratch my back, I'll scratch yours. None of that's good for the economy. So I didn't realize this slide had made it in here, but yeah, that's what that's saying.
all good. And again, back to the Google searches. And this is one that just yeah, it's you don't invest if you're Googling or a bunch of people are for a soft landing and they're hopeful, It's not time to get in. You should usually do contrary to what your emotions tell you.
Yep.
But this one, a lot of people are searching soft landing, and it looks like that tells us something about how the market's going to do.
Yeah, I mean, other spikes, right? Before the all-time high was back here in May of 2007. Is that right? No, 2008. And of course, that was headed right into the teeth of the great financial crisis. So soft landing, by the way, is not a new term. It's been around since the 70s when we were, no, 60s, I guess, since we were trying to land on the moon. And that's where the term soft landing comes from. It's hilarious. I learned that in a newsletter like last night. Um, but yeah, it has to do with the soft landing on the moon. And here's a fun fact for you. We have pulled off way more soft landings on the moon, we being humanity, uh, than the bankers have pulled off in the economy here on Earth in history. So more soft landings on the moon than in the economy. The only time the bankers pulled it off in the United States was in 1994. So one time only has it ever worked that we got a soft landing in the economy. But as you know, we've landed, a number of human beings on the moon and countless other spacecraft on the moon softly. Sure, there have been lots of hard landings, but way more soft landings on the moon than in the economy. And other spikes, right, were met with subsequent declines. Most recently here, I guess that's what, late 2021, heading into 2022 when the market dropped. And so now we're at an all-time high for soft landing Google searches. And, what do you think well, this peak here actually coincided with a little drop as well. So who knows what's going to happen here? Wouldn't be surprised again to see us drop. I mean, that might be a little extreme, the old lows right there from 2022, but again, anything's possible, man. Anybody who tells you that the market can't make a new low from here isn't paying attention. It absolutely can make a new low from here. Whether it will or not, I don't know, and I'm not even going to speculate on. But I certainly am not going to rule it out. You always got to be ready for the
Yep.
market to go down further than you think it ever possibly could.
And you and I can agree there. Every day you got to wake up and just be open to the idea the market could go up or down
Yep.
far more than you would ever expect. So
Yep.
good rule of thumb there. Um, Effective funds rate, back to this one, has not been this high since really 2007. Filters through the economy, and we'll see what the implications are. But again, not really a bullish number to look at.
No, and I think I've alluded to a couple of times now, just on this call that like it feels eerily similar to things that we saw back during the great financial crisis. And, one of those things is the soft landing. Another thing is that, rates were exactly the same level they are now. 5.25 to 5.5 was the range. This is a little bit off just because it's the effective Fed funds rate, but the range was in exactly the same spot after being hiked by a lot, just like hiked by a lot here. And when the Fed started cutting rates, right, everybody thought for a while, oh, it's going to be good. Market's going to rally. Fed's cutting rates. And then wham, great financial crisis hit, sending the market down. And, Fed continued to cut rates, started QE back then. And so it's again, let's say that they do, just keep it flat and then have it start going down here like this. And here's what's going to happen is, a recession is is like invariably going to, if they do that, probably there's a recession coming right there, right? And I don't know what that translates to as a date, but it's not going to be, the recession won't come usually until after they start cutting rates. Same kind of thing happened here. Rates were down and then the recession hit.
Yep.
So cutting rates, everybody wants to say, oh, cut rates lower, market go up. Rates lower in anticipation of market going down bigly.
That is right. So I think you and I both agree on that one. So and Powell said it, and it's funny, he highlighted it, but he sure didn't lean one way as, oh, well, if cutting rates, we would do that because we've accomplished our mission all as well. Or is it because the world's fallen apart?
Right.
Um, I don't know if they've ever cut just because things were good.
Yeah, he
You
did
know,
say it could be a sign of normalization. And I was just like, in the answer to a question, I was just like, yeah, it could be, but it's not. You know? Like, yeah, I don't know. I could win the lottery, but I won't. I don't even
Yeah,
play the dang lottery, so how am I gonna win it, you know? Anyway, yeah, it's funny. They're not gonna cut rates because everything's good. That's for sure.
no. So, again, personal interest payments just sky high, and look at that line. I mean, geez,
Like,
straight up.
yeah, geez is exactly right. Like the inflection of that line compared to all these other ones is bonkers. I mean, it's honest. Like when I saw that last night, um, it kind of freaked me out a little bit, you know? Like even though I had known about the government interest payments going over $1 trillion, like this is crazy. This is people's interest payments that they're actually paying. So it's not student loan interest because that hasn't been paid for a long time. So that's not included in this spike. At least I don't think it is. I don't know how they could do that. It's not like interest owed, it's interest being paid, personal interest payments, right? So it's just everything but the mortgage.
Yeah. And something I want to make sure this is clear, and Shane, correct me if I'm missing it here, but it looks like this is notional dollars. So
Yeah.
if it, so a percentage change chart would truly give us an apples to apples. But even with this, that you can't tell me that from 2020 until present, inflation was 100%, because that's what this looks like,
Mhm.
348 to 571 in terms of interest payments. So people took out a lot of debt that they owe payments on somewhere in between.
Yeah, well, the credit card balances are at 1 trillion and interest rates on credit card balances are 24% an all-time high. So there you go. The highest debt balance on credit cards of all time and the highest interest rate of all time recorded. Like that, that'll do it.
Yep.
That'll do it.
So uh, that image says it all. So and that's from the Big Short, which
Yeah, well, that's
um
exactly the thought that went through my mind when I looked at that chart last night. I had that exact feeling from that clip. I was like, whoa. So I had to go get the picture and make it because apparently that they don't have that one as a GIF anywhere on the internet. Maybe I should make that.
I certainly think it fits. But and again, that's always a good movie to go out and watch if you just want to understand markets. And it's always the surprise that people did not anticipate that makes the biggest spill. So you're seeing a deteriorating economy, but what's going to be the catalyst? And
Yep.
that's the guessing game.
But it's funny too because in that movie you see how long stuff can go on without making sense and how frustrated people who are looking at the data and seeing underneath the hood, they see what's going on and they're like, how is the market still going up? Like this is all massive manipulation. And then, people call them crazy the whole time. Like, you're crazy. Their clients fire them, yeah, just in time for them to ultimately be proven right down the road. So it's not any different this time. That kind of stuff is still happening. And, if you're not on the right side of it, and it's actually quite frustrating, to like see people doing things that make absolutely no sense and they keep making money doing it, so they're thinking they're right and they're proven right up until the point where the whole thing comes crashing down and they give back all of their gains and then some, and then it's like, oh, I guess that wasn't right.
Yep.
And so I'm not saying that's what's going to happen this time. I don't know. I mean, despite the fact that we are looking at the data and the fundamentals, we're staying long. We got like 4% cash in our capital strategy right now, long a bunch of good names, good stocks that we believe in. And, some of them are terribly expensive and make absolutely no fundamental sense. But, that's why we use stops. I mean, we can stay long a totally nonsensical market and, get out before we get hurt by it. So, as frustrating as it is, that's what we do.
Yep. So and then this one, just talking about yields again. Shane, if you want to just cover this one.
Yeah, I mean, it's really spread across two charts. So right now we are still in a situation where the yield curve is inverted. So the 2-year treasury has a higher yield. So the 2-year is 4.34%. And the 10-year treasury is at 3.88%. They've both come down from here. But the 10-year is coming down faster than the 2-year at this point, which is why the curve has further, or the spread has further inverted. So we're still at negative 46 basis points, which is, usually precedes a recession. And this is one of the longest inversions we've ever seen. The curve has been, or the spread has been negative since July 5th of 2022. So we're going on a year and a half without this thing being positive, and that is also not indicative of a healthy economy. It's indicative of more risk in the short term than in the long term, and it disincentivizes a lot of banks from lending and doing business that would fund the economy, which is why you saw so much government spending last year to keep GDP up, is because it wouldn't have happened without the government spending the money, because the banks aren't lending. They've tightened their lending standards, and they won't give as many people loans. And so, this is just indicative of a unhealthy economy. And if you go to the next slide, oh, I guess I got one more thing to show right after this. Maybe I'll have to share my screen. Well, no, you can go to that one. You're good.
All
Go
right.
to the next one. So this is the long term. So this is where we are now, right? This is the minus 46 basis points. And so what you see is that usually the curve reverts back above zero right ahead of this gray shaded area, which is a recession. So every recession that we've seen since the 80s has been preceded by a yield curve inversion. And remember, I said it's been a long time. Like, this is the longest one we've seen, and quite, like, here was barely inverted for even a little bit. Here it uninverted, reinverted, and then reverted again. So that amount of time is not the same as that amount of time. This is a shorter period, and I don't know, that one might be pretty close, uh, but it's the deepest, longest inversion on this chart, without question. And so it's not a guarantee, but it's not illogical to think that we would have a deep and long recession following the deepest, longest inversion.
Right.
So kind of the longer this goes on, the worse the potential recession on the other side could be. And that doesn't, it doesn't mean like it's the end of the world and you should never buy stocks again. That's not what I'm saying at all. I mean, you can still buy quality stocks and hold them, and you might never even stop out of them in the coming recession and down market. Some stocks are that good, you're just never going to sell them. Coca-Cola and Hershey and McDonald's and things like this. They might go down a lot, but probably just want to buy more of them when they go down. So, anyway, I'm not saying that you need to like sell everything and go hide in a bunker. That's not the point. But to see what's coming, raise some cash ahead of time, like Mr. Warren Buffett has been doing, so that you can put that cash to work in the world's greatest companies at bargain basement prices. That's the name of the game. And it's all about patience. It's all about patience.
It is. All right. And then Shane, you found this one from the Babylon Bee, but hilarious, but also not.
Sad but true, as Metallica would say. So yeah, I mean, it just speaks for itself. Like, prices have not come down, and so when you get guys like, you may have heard of this guy. His name's Joe Biden. Um, no, I think he lives in this place called the White House. And he tweeted a couple weeks ago about how companies should stop raising prices and stop gouging people, probably trying to influence that survey that we saw earlier. And it's like, dude, he was like, you guys got to stop raising prices because inflation has come down. It's like he fails to understand that 3% inflation means a 3% increase in prices from a year ago. There's no decrease. It's just 3% higher instead of 9% higher. So that doesn't mean you cut prices as a business. It just demonstrates a fundamental lack of understanding of what inflation is versus disinflation versus deflation. And I'm here to tell you that when we start talking about deflation, which means prices actually going down, look out below, because that's when people will start selling stocks.
Yep. So perfect. Well, Shane, you said you had something you wanted to share?
No, that was it. I figured out how to do it on that last slide, so we'll call it there. I know it's been a bit of a long call. I thought it might be a short call given that it's the holidays and stuff, but there was a lot to cover there, and it was fun.
There was. So, well, Shane and everyone out there, have a Merry Christmas. And Shane, I will see you in the new year.
All right, Merry Christmas, buddy.
Merry Christmas.